Something massive just happened, and it sent a shockwave right through Wall Street. SoftBank Group, the titan that has practically defined global tech investing for the last 30 years, has once again hit the sell button to the tune of billions of dollars. The target? A complete liquidation of Nvidia. 32.1 million shares gone in a flash. For Western investors conditioned to believe that Nvidia only goes up, seeing that ugly red candle in after-hours trading looked like a dangerous signal of retreat, perhaps even a betrayal. After all, Masayoshi Son was once AI's most fanatical evangelist. But if you think Masa is simply taking profit off the table, or if you think this is just about patching up holes in SoftBank's balance sheet from previous years, you are missing the forest for the trees. You are looking at the first layer of the chessboard, while Masa is playing 4D chess. This isn't just an exit. It is a silent yet deafening declaration. The infrastructure era of the artificial intelligence revolution, that golden age where you could make a fortune just by selling the hardware, is officially over. Let's fast forward and look at this from a future perspective to deconstruct the massive global capital migration hiding behind this trade. We are going to tackle 3 critical questions. First, why is the AI hardware bubble destined to burst? Second, why is smart money intuitively flowing toward the east right now? Third, as individual investors, how do we build a portfolio that survives this clash between geopolitics and technology cycles? Hello everyone, welcome to the channel. I'm your host FutureFi. Let's dive into today's deep dive. Part 1, the ROI wall. First, we have to answer the core question: why sell Nvidia? Think back to the period between 2023 and 2024. That was the infrastructure frenzy. Microsoft, Google, Meta, these giants were locked in an arms race, panic buying GPUs. If your company had anything to do with computing power, your stock went to the moon. In this phase, Nvidia was the monopoly selling the picks and shovels, TSMC was selling the water, and the utility and cooling companies were collecting the entrance fees. But today, we have hit a wall. Wall Street calls it the ROI wall. Return on investment. Capital is starting to ask the soul-searching questions. Asterisk. We've poured trillions into data centers, burning hundreds of millions in electricity every month. But where are the killer apps that generate real cash flow? ChatGPT is cool, sure, but can the profit it generates cover the massive depreciation costs of those expensive H100 chips? SoftBank's liquidation sends a clear message. The era of easy money in hardware is over. As the market becomes flooded with chips, profit margins will inevitably revert to the mean. The investment logic has shifted from who owns the most computing power to who can monetize that computing power the best. And where did Son Masayoshi deploy that massive pile of cash? OpenAI. This is a highly strategic signal. He has pivoted from being a contractor to a developer. It's like the late stages of the gold rush. He stopped selling shovels and started investing in the jewelry stores that actually sell the gold to the public. Part 2, the forgotten value trough. Why China? If the hardware story is played out, where does the money go next? This leads us to today's most counterintuitive and controversial topic. Just as the AI hardware trade in Silicon Valley becomes dangerously crowded and US equity valuations reach nosebleed levels, the radar of top global hedge funds is quietly turning east to China. I know, many of you watching might be shaking your heads. For the past few years, the Western narrative on the Chinese economy has been overwhelmingly negative. But in the world of investing, consensus is expensive, and truth is often held by the contrarian few. Let's look at the data. Imagine for a moment we are in late 2025. The Shanghai Composite is marching toward 4,000 points. To a Western investor, that's just a number. But for anyone who knows financial history, psychologically, that is equivalent to the Dow Jones breaking a massive new resistance level. It signifies a return of confidence and a wholesale repricing of assets. Why is capital flowing back? It comes down to a simple seesaw theory. On one end of the seesaw, you have the Magnificent Seven in the US. They are excellent companies, but the trade is overcrowded and their valuations have already priced in the next 3 years of growth. On the other end, you have Chinese assets. Due to geopolitics and the Federal Reserve's aggressive rate hikes over the last few years, global liquidity fled the region, leaving it as a severely undervalued value trough. But a trough doesn't stay empty forever. Water flows downhill. As the Fed enters a rate cut cycle, the cost of the US dollar drops, and capital instinctively hunts for higher yields. Meanwhile, in China, after years of painful adjustments, whether it's internet giants or high-end manufacturers, balance sheets are healthier, cash flows are robust, yet their stock prices are still sitting on the floor. For Wall Street's hungry capital, this is essentially free money left on the table. SoftBank sees it, Bridgewater sees it. Heading into the 2026 market cycle, this is going to be a feast of mean reversion and valuation repair. Part 3, hunting for alpha, 2 core investment theses. So in this ancient yet emerging market, how do we target our investments with precision? I'm not going to give you fluff. Let's talk about two hardcore investment. Logic 1, hard tech sovereignty as a geopolitical hedge. In the US market, we look at user growth and profit margins. But in the Chinese market, to generate alpha, excess returns, you must learn to read the national will. The current global landscape is a dynamic equilibrium of US-China competition. The US restricts high-end chip exports, which paradoxically forces China to break through in these choke point sectors. This isn't just a slogan anymore, it is an economic lifeline. What does this mean for your money? It means national resources, policy subsidies, and top-tier talent are flooding into these sectors regardless of cost. The opportunity here isn't in the massive conglomerates, but in the hidden champions specialized, mid-cap companies dominating a niche. Think of the heart of high-end manufacturing. Aero engine blades and 5-axis CNC machines. Think of the foundation of basic science. Industrial-grade sensors and EDA software, electronic design automation. In the past, Chinese companies just bought these from abroad. Now, domestic substitution is mandatory. This creates a multi-billion-dollar empty market. In China, a small technical breakthrough, like perfecting a specific alloy formula, can trigger a massive chain reaction in the stock price. This is where we find hard tech alpha. Logic 2, the iPhone moment for AI applications. This is the lesson from SoftBank pivoting to OpenAI. Technology itself isn't the goal. Application is. If the US excels at 0 to 1 innovation in underlying models, China is the undisputed king of 1 to 100 scaling and application. Think back to the mobile internet era. After 4G networks were built, who won? Not Ericsson, who sold the base stations. It was Uber, who changed how we move, and TikTok, who changed how we are entertained. The same story will replay in AI, but 10 times faster. Why China? Because it has the world's largest population of digital natives and the richest data scenarios. Imagine this future. AI seamlessly integrated into WeChat, an app with 1 billion users, becoming everyone's personal assistant. AI shopping guides becoming standard on Taobao and JD.com, revolutionizing e-commerce. Apollo Go robotaxis, becoming as common on the streets of Beijing as yellow cabs once were in New York. These scenarios are happening in China times, right now, asterisk. For investors, this means watching the internet platforms that hold massive user data. AI isn't disrupting them, it's giving them wings. The next trillion-dollar application giants will be born here. Part 4. The barbell strategy, offense and defense. You might be thinking, the volatility in emerging markets is crazy. How do I buy this safely? On Wall Street, we use a classic tactic called the barbell strategy. Imagine a weightlifting barbell. You only hold assets at the two extreme ends, and you completely ignore the mediocre middle. The left end, the fortress of defense. High dividends. We lock in China's blue chip stocks, banks, energy, telecoms, and toll roads. 2 reasons for this. Their dividend yields are incredibly high, often exceeding 5% or 6%. In a rate cut cycle, these are cash cows. 2. Safety. These companies are often backed by state credit. They are highly liquid safe havens. Holding them is like buying an insurance policy that pays you. The right end. The spear of offense tech growth ETFs. For most overseas investors, analyzing individual Chinese financial reports is difficult due to the language barrier and information asymmetry. So, ETFs are your surgical scalpel. Look at the Hang Seng Tech Index. It includes the most dynamic giants like Tencent, Alibaba, Meituan, Xiaomi, and Li Auto. Buying this is buying half of China's digital economy. It is the most efficient way to bet on the AI application boom. Beyond that, look at the Star 50 Index, the Science and Technology Innovation Board 50. If Hang Seng Tech is China's Nasdaq, is China's future Philadelphia Semiconductor Index. This is pure hard tech exposure. Finally, I want to say this. Investing is the monetization of your perception. SoftBank clearing out Nvidia isn't a bet times against times AI. It's a bet on the times next chapter times of AI. Masayoshi Son is reminding us, don't fall in love with the battlefield of yesterday. Look toward where the war is moving. For global investors, the Shanghai Composite hitting 4,000 is more than just a number. It represents a structural rebalancing of global asset allocation. Water flows to the lowest point, and capital does the same. When Western asset prices have already mortgaged the future, the value trough in the East begins to exert an irresistible gravitational pull. In this volatile year ahead, seeing the flow of the trend is more important than blindly chasing hotspots. Don't be the guy arriving at the gold mine after it's already been dug empty. I am Futurify, your financial guide. If you enjoyed this deep dive and macro deduction, please don't forget to like, subscribe, and hit that notification bell. It really helps the channel. I'll see you at the next wealth opportunity.